Now, very good afternoon, good morning. Welcome to HYCM's workshop with myself, Giles Coughlin, a chief currency analyst. I do hope you're well. I'm glad you could join me for this HYCM workshop, and I will be showing you a few things in today's workshop. First of all, before we get started, don't forget, as we talk about different entries and exits, the whole idea of this is an educational webinar, and it's not meant to be a webinar that gives a signal trading service. So even though we talk about different entries, exits, different instruments to trade, it's not from a trading advice perspective, it's from an educational perspective. And one of the key aspects that we want to learn when we're trading is how do we pair strength against weakness? And this is very true in FX. So I'm going to show you two examples of that today, as well as getting ready for the ECB meeting. So I'm going to show us one currency pair that is strong against one that's potentially weak, and I'll show you how to use technicals to manage that risk. I'm also going to show you what's going on with the China 50 index. We've been looking at that potentially from a long bias. That's moving nicely, and I'll explain why that's moving nicely and how to define risk. We're also going to look at a commodity, natural gas, and I'm going to explain to you why there's a lot of upside potential for natural gas. I'll show you the risks and again how to manage that. And we're also going to look at trading the ECB rate decision tomorrow. So wow, we've got a lot to do. So without further ado, remember when we're trading, we'll look back strength against weakness. So just as you'd expect the strong arm to beat the weak arm, we want to trade the strong currency against the weak currency. Now we will be looking at trading the ECB rate decision, but we've got a lot to do. So before we do that, I want to go over to look at the charts and show you something important. Now, yesterday, the RBA made quite a bullish turn. Now, the Reserve Bank of Australia surprised markets by hiking interest rates by 50 basis points. Now, we saw that was a surprise, and the Aussie New Zealand dollar gained as expected. Now, I am currently long Aussie New Zealand dollar, but it is possible to go long on any retracements back down to this support level marked here. Now, what's happened is the RBA was expected to hike interest rates by 25 basis points. Instead, they hiked by 50 basis points. Now, when a central bank hikes their interest rates, it means it's more attractive to hold cash deposits. So investors around the world are incentivized and attracted to put their money into Australian dollars. So that's why the Australian dollar gains value. Now, one little tip to look at this is the bond yield spread. And do you see that small green line across the charts? That green line is the yield spread between Australian 10-year bonds and New Zealand 10-year bonds. Now, what the bond yield spread essentially shows you is kind of the outlook for Australia relative to New Zealand. And the bond yield spread moving higher shows you that Australia's outlook has improved relative to New Zealand's outlook over the last few months. And this latest decision by the RBA simply highlights that fact. So there is an Aussie New Zealand dollar upside bias from that return to that 1.100. Now, if the yield spread keeps dropping lower, we'd expect the Aussie New Zealand dollar to keep moving lower. So if you just took this off, one potential is to look at, you see this tentative trend line on the bond yield spread? If that holds, then it's reasonable to expect the price of the Aussie New Zealand dollar to keep moving higher. If that sort of breaks lower, then that could be the first indication that something's up. But this is what we'd expect on a surprise interest rate hike, and short-term interest rate markets are now pricing in 50 basis points hike for July. So this should keep gaining over the medium term. This is a good area to potentially go long. I'm just going to see if there's any other technical areas to get into. No, that's all right. Yeah, I mean, a little technical area you could potentially enter is enter a market with stops below that 1.1389 on the 4-hour chart, and then just trail it below the low of each candlestick. So you could enter potentially here technically at market, stop sub 1.139, and then just trail it below the low of each subsequent 4-hour candle. That would be legitimate technically. Now, we also want to look at the Aussie yen. Now, there's a couple of things to note on this. The reason the Aussie yen's gaining is because the yen keeps getting weaker and weaker. Now, if you don't know why the yen's getting weaker and weaker, it's because 10-year yields are moving higher and higher. And you see how close the 10-year yields follows the Aussie yen pair. It's the same with the US dollar yen. So when 10-year yields rise, that weakens the yen and lifts the Aussie yen. So Aussie yen upside makes sense. And if you look at here, we just see we're breaking through this trend line. So Aussie yen buying makes sense at market, stops sub 94, looking for a move up to 100. That's legitimate. Now, if price moves back below that trend line, that would be an area to exit. Why? The RBA's hiked by 50 basis points. The Bank of Japan is expected to keep interest rates very low. Here's a problem with this, and I'll show you the major risk. There is a big risk with this. And it all comes down to this level of the dollar yen. Now, if the dollar yen hits 135, there has been a previous Bank of Japan governor who has mentioned that 135 is the area where the Bank of Japan might get worried about a weakness in the yen. So a weak yen helps Japan in that its exports become cheap relative to other exporters around the world. Okay, so that makes your Toyotas, cheaper than your Fords in relative terms. So very, very good. But the problem, of course, is that if the yen gets too weak, it means that the import costs increase. Also, notice that when oil prices increase, that weakens the yen because Japan is a net importer of energy. High oil prices weakens the yen too. So let me just show you that relationship so you can see that, nice and large for you. It's always helpful to see these relationships on this chart. So if you just look at US oil, and we'll just take off these 10-year yields. You see, as oil increases, the yen weakens. So expensive oil, weaker yen. Now let me just invert that scale, right? There's this one. Where's oil prices there? There we go. You can see, higher oil prices weakens the yen. So I've inverted the yen there. Okay. So as oil prices gain, the yen weakens. There we go. Right, lovely. So what you have to watch out for is if you're going to short the yen, you have to watch out for this 135 region. We might get a bit of pushback. So be warned, okay? Be warned. You might suddenly see the yen weaken at that point. Okay, so that's outlook on the Aussie New Zealand dollar. And there's another little outlook I want to share with you, which is nat gas. Now, nat gas has been on a rip recently. Now, the reason for natural gas ripping so much higher has been the Russian supply issue. Russia has a huge amount of natural gas, a lot of which it exports to Europe. That's now come offline. So supply chain issues due to COVID-19 have been compounded by supply issues regarding Russia's invasion into Ukraine, which has been further compounded by the fact that world demand here in the blue line is expected to grow and exceed world supply. So even Russia production, you can see demand is set to outstrip supply, right? You see the issue here. So what that means is as we head into the winter, what are savvy traders going to be doing? They're going to be buying natural gas, aren't they, in anticipation of rising gas demand. So that means the normal kind of, and I'll just show you this here, normally, take a look at this, natural gas prices normally weaken at this time of year but I'm not expecting to weaken this time. You see, like 2000, 2019. Ignore the COVID years because of weird demand. But you see, generally speaking, you get low demand from natural gas. Not this year, expecting it to really move higher. So as a consequence, just looking at the natural gas chart, where can you buy in? Buying in at 7 would be ideal. Or this is what you can do when markets are really tight like this. Just look for a real sensible area to enter. So a sensible area would be like this, a break of that trend line. You see you've got 1, 2, 3 touches. That means a break of this trend line higher, a break of 9.60, that would be suitable for going long, and just keep, as long as you stay above that trend line, stay with it. If you get back below, exit. So I would favor buying on a dip or a breakout, not a market, because you can see, look, prices could easily drop lower from here, can't they? But look, you've got some great, technical setups here, bullish reversal, hammer bar, another couple of bullish reversal, bearish reversal, bearish reversal, hammer bar there, very, very nice. So yeah, at market, no, with a break on a longer term move, you see, heading into the winter. Look, it all makes sense, right? And especially if China's coming back online, then Chinese demand for natural gas is going to increase. So you'd expect natural gas prices to keep rising. So natural gas market should keep supported. Risk here, big one. If Russia and Ukraine manage to come to some kind of agreement, some kind of peace agreement, then you could easily see natural gas prices plummet. So be very careful and mindful of where your stop is. If there's any kind of resolution of the conflict, natural gas supplies are coming back online, natural gas prices should plummet. So be very, very mindful of that environment. Okay, so now one last thing I want to show you is China's 50 index. We've been talking about this for a long time. And just a couple of things to note technically. Do you see the way that these bottoms have also been in with high volume? When you tend to get like large moves on high volumes, that's often an indication of like a big shift. So you can see here, a bottom, hammer reversal bar, large volume, bottom, large volume, bottoming, large volume. So these larger volumes at these levels indicate heavy buying. So there's a lot of people invested at this level. Notice as well, we've got this massive hammer reversal bar here. If this breaks higher, above 14,000, then we're looking at a test of 14,500. Now, the reason this is so attractive is because, look, China's stock index has fallen 40% since last year. And China is now cutting interest rates. It's boosting lots and lots of stimulus. And make sure you check out my blog. I go into this in significant detail on my blog, which is here, or blog.hycm.com. Let me just show you here. And if you just go into the top of my blog and search China, you will see I've written lots and lots about China. Read these articles. Here's one of the latest ones I wrote just before June, just noticing that trend line break. I'm just going to pop that in there to the entire audience. You can check that out, and you can just see, the analysis and that link there being bold on China. Just goes back and shows you, all of that boost, and you can see there's a huge structural boost that's expected for China. Okay, so that should be very, very good longer term. So do check that out and make sure you don't miss out that outlook. As I said, don't want to buy this at market now. Any retracements lower, as long as you stay above that trend line, stay with. Get a break above that level, potentially look for a retest of 1400, ultimately looking for a move back up to 14,500. Okay, that makes sense there. Holding this for a long time, then obviously I don't think it's unreasonable to expect 16, 1700. That seems perfectly reasonable. And certainly good areas to look at as we move forward. Okay, that's excellent. So now let's return back. There's much more I could say at markets at the moment. There's a huge amount of things, but let's just keep with the tasks ahead. Tomorrow we have the ECB rate decision. So let me just show you when that's coming. So tomorrow, ECB rate decision coming up at 12:45. What's expected? Interest rates to stay unchanged at minus 0.50%. So I'll just go through and show you what's going on there. So the ECB rate decision, economists' projections are for no change, but short-term interest rate markets are expecting a 10 basis point change. Now, whenever you're trading central bank decisions, what you must know is what are the expectations? What's expected, right? That's crucial. So short-term interest rate markets are expected, so they're expecting a 10% basis point. So if there's a 10% basis point, it's 64% chance of it. So that means there's 36% chance that it won't happen. So there'll be a bit of repricing. If there is an interest rate hike tomorrow, you'd expect to see the euro gain. So, and this is what's expected from the forward guidance. 4 25 basis points hikes are expected year end, 1 hike in July and 1 in September. They're fully priced in. So if Christine Lagarde says there's no change, you expect a hike in July, a hike in September, that's fully priced in. But that shouldn't make any difference at all to the euro. Things should be pretty much flat. But this is what we want to look for. If Christine Lagarde says, okay, there's a possibility of a 50 basis point hike in July, then that would be euro positive. We expect to see more euro pound upside. Okay. If there's a surprise hike and it's 25 basis points, you'd expect to see some nice upside in the euro. Okay, definitely look out for that. Upside in 10-year bonds, upside in euro pounds. But if it's dovish, say Christine Lagarde stresses geopolitical risk, maybe she stresses about what's going on with Russia and Ukraine, maybe she talks about worries about slowing growth, then that could weigh on the euro, and particularly you wouldn't expect euro pound downside, but particularly expect euro dollar downside. Okay, that would be the go-to currency pair for trading. So what you're really looking for tomorrow is signals about a 50 basis points rate hike. We have had a lot of central bank speakers, and you consider what the inflation is like for the Eurozone. It's very, very high. We've had a series of central bank speakers coming out talking about, inflation being high and potential for 50 basis points rate hike, et cetera, et cetera. So let me just show you the, we're just going to focus in here on the Eurozone. All right, Eurozone. We'll take the medium and high. Just focus these out. Then we'll just look at the dates. So if we look at 1st of May through to end of June. And we'll look at the inflation data out of the Eurozone. You'll see how that's been going up and up and up. So a couple of things to note. We want to see just the Eurozone. Better. So producer price index going up. In other words, producers are having to pay more to produce their goods. That's inflationary pressure. We've also got core inflation headline 8.1% year on year, above the expected 7.7%, just under the maximum expectations of 8.2%. The PPI for April was down. That's good news, and that means less price pressure on the ECB. but the headline inflation from the end of May, that puts a lot of pressure on the ECB. And we have had a number of ECB speakers talking about maybe a 50 basis points rate hike. See, the core year on year is at 3.8%, which is the line with the high. So the ECB will be pressured to deal with inflation. So a couple of things to note. One, the RBA turned more hawkish with their recent interest rate decision. Two, the Bank of Canada turned more hawkish with their last interest rate decision. So it's not unreasonable to expect the the ECB to potentially turn more hawkish. But they have communicated a lot already about an interest rate hike expected for July and September. So just watch out. It's a tricky one to trade, but the best opportunity will come from any talk about 50 basis points a rate hike for July. That's the best opportunity, or anything like a surprise hike, and then look for upside Euro US dollar, potentially Euro pound as well. Okay, folks, if you could just let me know that you can, any questions that you have. This would be a good time to ask any questions. And if I can help you, just pop it in the chat box. Anything that's not clear or anything you need some help on, happy to help out here. That natural gas market was very interesting. It's quite persuasive given the fact that there's so much global demand but so little supply. Okay, folks. Don't forget, on Monday, I will be back here again to look at the key risk events coming up for next week. So I do hope that's helpful. And thank you all very much for attending. And do stay in touch. If you're not following me on Twitter, make sure you follow me on Twitter. I do put a few updates there from time to time, as well as my LinkedIn account. You just look up my name there, Giles Cochran. My Twitter handle is here. I'll just put it in the box. It's at Giles Cochran CCA. That's my Twitter handle. So you can follow me along Twitter there. Thanks, everyone. Good to see you, Setley. Salvatore, good to see you as always. Mohammed, take care and look forward to being back shortly. Thanks, everyone now. Goodbye.